What's up, guys? So I often use a term called LOK syndrome, or lack of knowledge. And unfortunately, in the finance industry, there are actual professionals that suffer from lack of knowledge, or LOK syndrome. And I had a video sent to me by a friend on TikTok, and I've seen a lot of these TikTok videos in the past that offer investment ideas or financial advice, and the majority of them are absolutely terrible. But I thought I would review this one today and just give you my thoughts on it.
Millionaires don't want you to know. Here's just a regular person. Every Friday, they get paid, they put their money in the bank. But what you guys don't know is that they put their money straight into life insurance. And a lot of you are probably like, what? Life insurance? Why life insurance? It's for death benefits. You die so your kids can get a check. No, it's marketed to you backwards on purpose. It's supposed to be meant for the life benefit. Let me show you why. The reasons why banks own life insurance is because they get a 10% average interest rate.
Okay, so I think he's talking about an IUL, or Index Universal Life Policy, which is, it offers cash value buildup, but also tracks an index like the S&P 500. So you can earn, yes, up to 10%. Now, as far as the average earnings, it's different per company and how much they'll credit you. 10% to say that you're going to earn that average, that's a little bit high. But I think that's where he's going with this.
On your money, and it's not locked up in money jail like a 401k or a Roth IRA. They can pull the money out and use it to give to people for cars, for mortgages, personal loans, business loans, college loans, and credit cards. They're making all this interest off of your money, and they stack the interest and they get 57%.
Oh, hell no. Okay. Before I even tear this math apart, I can't even let it get to the math because the math is terrible. But think about this. First of all, you can own life insurance on someone else, but you had to have an insurable interest to own that life insurance. So as far as the bank's role, them owning life insurance on someone, an insurable interest would come from maybe an employee or an executive or someone that they've lent money out to. Now, an IUL is more of like a permanent style kind of life insurance, and not like necessarily has to be permanent, but is usually for a extended period of time, and are also more expensive. But besides that fact, and sorry, I'm just trying to get my thoughts clear on how stupid this is. The bank is going to lend you money, but not forever, right? You let's say you got, like, he has a car loan, a 5-year loan. And let's say they were so worried about something happening to you that they made you go and get life insurance to cover money that they lent out. They want to make sure that they're going to recoup the money that they've given you. A car loan may be 5 years. Well, it's going to be in the form of like a term life insurance policy. They're not going to hold life insurance on you past the time that you've lent money out. Once you pay it back, they don't need that anymore. They don't have an insurable interest anymore, and they're not going to keep paying premiums for it. So that's dumb comment number one. Dumb comment number two, he has the IUL earning 10% interest. Now, if the bank was to utilize IULs, which they can on like their employees or an executive, but it would actually be in the favor of the executive or the employee. But that's neither here nor there. If they were going to own life insurance that is making 10% interest annually, the reason why you would have those life insurance policies is because the tax advantages in them. So they can offer some of the same benefits that like a Roth IRA would offer, where you fund the premium, you earn the interest, and you grow the cash value, and you can actually pull the cash value out later on down the road tax-free. Why in the hell would they pull their cash value out of the tax-free money that they don't have to report as income, earning 10%, and lend it out in a car loan earning 5%, that they now have to report that 5% interest they're making as income and pay taxes on it. So if you lent it out to someone, buying a car with a 5% interest rate, you're making half of the money that you were earning on the IUL. And in the IUL, it's compounding. And on the car loan, it's a simple interest rate. So, it's just so stupid. And then you have to pay taxes on the interest income. So you're taking tax-free gains and it's backwards. The next thing is you don't stack the interest. You don't add those up. So he has 6 different types of loans. If the bank has $1 million to loan out, they have to allocate that $1 million across all 6 of those kinds of loans there. Like, some to credit card loans, some to a business loan, some to personal loans, mortgages, whatever. Let's say they had half of their business in mortgages. So $500,000 of the $1 million is going to mortgages, earning 3%. That means that they're going to earn $9,000 in interest on the $500,000. So it would be a weighted average across those percentages. All right. You don't add up 5 plus 3 plus 10 plus 10 plus 6 plus 23 and get 57%. It's a weighted average. So let's say off the top of my head, if you split it up evenly, you would just average out those interest rates there. And let's say it'd be around, 11 or 12% on that, not 57%. All right, let's move on.
Interest. So by you putting your money that you worked hard for into the bank, you're making the banks extremely rich. Now, what if I told you that you could be your own bank? It's a concept called infinite banking, and I'm going to show you how to do it. The first thing you're going to do when you get paid is cut out the middleman. Then after you cut out the middleman, you put your money into something that's called an indexed universal life, where you can now get an average of 10% on your money.
Okay, dumb comment number 4 or 5 now. You can't cut the bank out of this transaction when you're doing the life insurance transaction. And here's why. If he's saying that you're cutting out the bank, then that's misleading to me as the consumer, because I'm thinking, well, then I'm going to, I guess, just pay cash for the policy or in some other form other than money out of my bank account. I've done a lot of IUL business. I don't know any company that would ever accept cash. And I'm almost 100% positive they can't accept cash because of obvious legal reasons. Life insurance, because of those tax advantages down the road, is heavily used in money laundering. So you can't fund it with cash. So how are you going to cut the bank out? Because you have really 3 main choices when it comes to funding it. You have like a wire transfer, ACH direct draft out of your account, or paying by check, all of which come out of your bank account. And if you have money at the bank, yes, they're taking that, it's in their reserves, and they're lending that out and earning interest on it. That's just how it goes. It doesn't impact you at all. But you can't cut the bank out. And it would actually be really funny to be in a meeting with this guy when he's selling this product to someone, and he gets to the page in the application where he asks for their bank account details. They're going to be like, what do you mean? I thought we were cutting the bank out of this transaction. Oh, well, I still need your account and routing number because we still do have to pull the money out of that account. We can't accept cash. Well, then what the hell are you talking about? Cutting the bank out.
I decided to just use this as like a high yield savings account, and you put $10,000 in there at 10%, and you did the rule of 72, 72 divided by your interest rate equals 7.2. So in 7 years and some change, your $10,000 will turn into $20,000 just sitting here doing nothing. But if you wanted to pull the money out, which you're allowed to do, then they're going to charge you 3%. So you're going to lose 10%. So now you're making 7% borrowing it. But you could put your money into something like real estate or a startup business or any other investment.
Okay. On a positive note, he brought up a good tool that I think everyone should learn. It's a very simple concept, and that's the rule of 72. What that's showing you is a pretty close estimate on how long it will take you to double your investment. So if you were going to invest in whatever it was and you think that you're going to earn an interest rate of 10% like he used annually, then you would divide 72 into 10, and that gives you 7.2 years that it will take to turn $10,000 into $20,000. If you think you're going to earn 5%, then you do 72 divided by 5, right? So good job on him explaining that, because I think that that's something that not a lot of people know, and it's just a very simple equation to do. But then he goes right into a misleading statement, and that's pulling that money out. So with the IUL policy and other life insurance policies that have cash value, you have a surrender period, usually around 15 years. Now, you can access some of the cash value that you have built up and interest you've earned before the 15-year mark, but you can't access all of it. It usually takes about 15 years before the surrender period goes away. Up until then, you have surrender charges. It's far higher than 3%. Now, if he's saying like you can take it out in 7.2 years, you're not going to get away with only leaving 3% of the cash value left in the policy and taking out 97% of that money. Absolutely not. You may have access depending on how it's structured, let's say 50 and 75% in that time frame, but you're not, it's going to be around 15 years before you can access the full amount of cash value. He is right. You can use that money however you want, whatever cash value you pull out of that policy, but you have the surrender charges, and it's going to be far greater than 3%, because what's misleading about that is there may be a 3% charge on the money you take out, but you're thinking that you have that full $20,000 to take out in 7.2 years, and you don't. You may have like $5,000 or $10,000 of that $20,000 to pull out, and then pay another 3% charge to pull it out. So I just wanted to clarify that.
And you're making an ROI of 25% on this real estate deal. But now you have this extra attached 7% on your ROI just by funneling your money into life insurance.
Okay, again with the math. ROI means return on investment. If you had $100,000 in cash value in a life insurance policy, and then let's say another $100,000 invested in a real estate property, the real estate's giving you 25%. That means you're earning $25,000 on your $100,000. Then on the other $100,000, you made 7%, is what he had as his net return. So 7% net return on the other $100,000 would be $7,000. So on a total of $200,000 with $32,000, divide 32,000 by 200,000, and your net return would be 16%. So it's not 25% plus 7%. You don't add the interest rates. Okay, it's a weighted average. Now, to end this, IULs can be good products, but it's all situational based. They're not for everyone. And he's selling it as if it's for everyone, and it's not. He's actually very misleading in the video, and I hope enough people actually see this to get a little more informed and not actually buy into what he's saying, because I don't know who he is. This was sent to me, and maybe he has other videos that are great, but this one right here is extremely misleading. And if someone were to buy a policy from him after he sold it like this, they may not realize what they're getting into. And that could end up bad for the client, because they can't just get their money back a lot of times. It could also end up bad for the agent selling it, because if it's, within that first year or so, he could get a charge back and have to pay the money that he made on the policy back anyway. So it doesn't benefit either party. So, that's kind of my view on that video. If you have any questions or comments, you can always email me. I'll have my email in the link below. If you like the video, hit like and don't forget to subscribe. Thank you.